Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management, and I'm here each and every week to help you create a better relationship with your money because after all, your money matters. Friends, we're almost, can't believe it, halfway through the NFL season, and by now, many of us have started wondering, I know I have, if our favorite team has a chance to make the playoffs. And I'm sure many of you have heard the phrase, defense wins championships. Well, there's another saying that we say here often in the financial advising world, that diversification wins returns. So today, we're gonna talk about two of my favorite things, finances and football. But before we do, smash that subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. To get started, I wanna set the stage with some war history, believe it or not, because I feel it's actually pertinent for today's topic. There's another saying that you may have heard, that is the expression, snatch victory from the jaws of defeat. Well, the origin of that statement can actually be traced all the way back to the Mexican-American War, which took place between 1846 and 1848. Now, as some of you might remember from your high school studies, at that time, America was on a Western expansion. We had just completed the annexation of Texas, and through the Mexican-American War, we had acquired New Mexico and my state here, California. Now, during the war, a regiment of American troops from Virginia had won a hard-fought battle, and a politician actually described the victory by writing, and I quote, "They snatched the victory from the jaws of defeat." Now that expression has really become a part of, I'll call it, our American lexicon. And it means that you win when it appeared that you would lose. But there's an opposite side to the expression that has also made its way into our nuances and our sayings, that is snatching or snatch defeat from the jaws of victory. Now this expression, to be clear, would be used when it appeared that something was going to be won, but was actually lost. And normally lost because of mistakes or bad judgment. Have any of you witnessed that in sports, or maybe in particular football? Now I'm gonna come back to those questions for a second, but back to the first coined phrase I mentioned at the top of the show, defense wins championships. Some of us subscribe to it, some of us don't, and I think that depends a lot on your sports philosophy. I won't get into that today, but let me give you an example. Now I have a couple buddies right now when I bring this up, watching and listening to this that are probably gonna be like, Brad, really, please don't bring up the 2015 Super Bowl, but I am. I'm gonna bring up Super Bowl 49 between the New England Patriots and the Seattle Seahawks. It was, to me, probably one of the better Super Bowls in recent years. And to be fair, neither one of the teams I was necessarily a fan of. But it fits perfectly around, I think, how defense wins championships. I'm also going to bring that into the investment world in how diversification wins returns. So if you recall, it was the fourth quarter with 26 seconds left in the game. Russell Wilson, the then quarterback of the Seattle Seahawks, and his offense had the ball on the New England Patriots 1 yard line with 1 timeout remaining. They were down by 4. They needed a touchdown to take the lead. So I just set the stage there. Now, it appeared to everyone watching this, and who remembers this about 7 years ago, it appeared that the Seahawks would win. In fact, it should have been really difficult for them to lose. And there was actually a CBS Sports outlet that wrote in an article, and I quote, "What transpired will live in the history of this league for as long as football games are played. A series of decisions, including the bizarre call by Seattle coach Pete Carroll to throw the ball on second down on a receiving route to a crowded middle of the field that will always be second guessed." Now, again, those of you who watched know exactly what I'm talking about. If you haven't, I want to play the clip because it's an important one.
Play clock at 5. Pass is intercepted at the goal line by Malcolm Butler. Unreal.
Now, Coach Carroll, as you saw, took a huge unnecessary risk when there was really no time to recover. Now, referencing Coach Carroll's play call, one former NFL player tweeted, "It was the dumbest play call in the history of NFL football." Now, the outcome of this game was much different than what would have been for Seattle, all because of what? Bad judgment. Now, we can go into theory on this one, but Seattle snatched defeat from the jaws of victory. Coach Carroll, being the stand-up guy that he is, in admitting his mistake, was quoted as saying, "I made the decision to throw. There's nobody to blame but me." Now, for all of those USC fans out there, myself included, being here and from Southern California, we love Coach Carroll. We're not exactly stoked on how he left USC, but we love what he did here. But Super Bowl 49 isn't too dissimilar to the same sort of game he coached in 2006 for my Trojan fans out there, which was now being referenced as the greatest college game ever played. It was the University of Southern California versus the Texas Longhorns, where Pete Carroll was also the coach at the time and made a very interesting call. I was at that game, by the way, so I remember this very vividly. On 4th and 1, late in the game, he took Reggie Bush out, the star running back, and decided to put in Lendell White. Again, another bizarre play call. Sadly, what I'm trying to say is this isn't the coach's first rodeo here in making some gutsy calls with no time to recover. And really, the result for both of these games, I'm referencing particularly Super Bowl 49, was the final analysis of it was a bad decision that led to a disaster for Seattle. The 2015 Super Bowl is just one example of snatching defeat from the jaws of victory. It's also an example of how defense, to my saying earlier, can win championships. Now, relating the war and football stories to investing, when you're in I'll call it the accumulation phase of your investment life, maybe in your 20s, 30s, 40s, maybe even 50s, and you're watching and listening right here, you're in your working years. You're working, you're saving, you're trying to figure things out. Questions like, where do I place these investments? How much cash do I want to invest? How much do I want to put into retirement plans versus my brokerage account? How much do I want to put into tax advantage brokerage account, by the way? All great questions, all great topics. And we try to cover them here every week on the Make Your Money Matter show. And here at One Capital Management, our firm, over the nearly $5 billion that we manage for clients across this great nation, we're answering those and planning for those questions and helping answer those for our clients every day. When you're on offense, to my example, when you're building, you're in the accumulation phase of ultimately your retirement life or your investing life. And as I often say, remember, retirement doesn't need to necessarily be when you're 65. It just when you become financially free from a job that you're receiving income from. And offense, if you think about it, can be somewhat easy. I know that sounds crazy to say because right now in this time period, we're also potentially starting, again, the accumulation phase where you might be. We're starting families, maybe buying a house, paying off that house or a mortgage, paying for education for kids. There's a lot going on in this time period. But when you get into retirement or becoming more financially free later and living off your money, you start realizing that once you reach the top of this mountain that you've built, you need to start going down, navigating those landfalls and becoming a little bit more, they become problematic is what I'm trying to say, sometimes harder because at that time, we don't have as much time to recover. Again, timing is everything. So avoiding some of the mistakes or bigger risks, like some of the examples I brought up today, I know it's a sports analogy, but something to think through when it comes to your investments. You have to be a little bit more cautious and pragmatic about your planning and what you are doing. Now, right now, if you're in that accumulation phase and you're watching and listening to me, you're running the ball down the field. You're contributing to your 401k plan or your retirement plan. You're saving, hopefully, after tax and before tax. You're putting your allocation to work, and hopefully, you're finding the right advisor and a good investment manager to help you choose the investments, to help you plan through that, because you will eventually want to find the right team members to build this team to win the game, which is ultimately, by the way, the game you're trying to win is becoming financially free and happy and healthy with your money, or getting to retirement or a stage where you can be financially free to live the life you want to live. Now, for some people, that's having a happy and healthy retirement, even in their 50s or 60s. I had a client not too long ago, about a 25-year-old, who was working pretty hard and heavily and wanted to be financially free. His goal was being financially free and retired by 40. He didn't say retired. He just said he wanted to be able to choose whether or not he wanted to work by the age of 40. So your unique goals and objectives need to be worked out with a good team member, a good advisor. Again, to use my sports analogy here, you don't just have a quarterback who's running the ball here. You have to have a wideout, you have to have a running back to move down the field with you. You have to have coaches, offensive coordinators, defensive coordinators, a whole team around you.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
And with talking with your advisor, they should be discussing something that we talk heavily about here, which is rebalancing. Rebalancing is essentially the process of realigning the weightings of your portfolio assets. Essentially, it involves periodically buying or selling assets in a portfolio to maintain the original or the desired allocation that we set out for each of our clients. So let me give you an example. If we meet with a client and we go through their wealth forecast, we put together their incomes, where they're making their money, whether it's salary or commissions, we'll put that all together on the income side, understand what their outflows are, meaning your mortgages, your lifestyle, whether it's kids' education. We'll make sure that we build a unique plan for you. We put it all together and we align that towards our client. Now, for example, towards their goals. Maybe it's 15 years, maybe they only have of working right now, so they have another 15 years to go before they want to be financially free or retired. Maybe it's someone who's got 30 years of working already and is looking to retire in the next 5 years or 10 years. So we're looking at understanding and matching the risk tolerance and designing an investment portfolio that'll meet the goals and objectives for each of our clients. And for each of you watching and listening, you have to do that for yourself. So let's say we did an allocation as, I'll call it a balanced portfolio, something that was basically equally weighted, maybe a little bit more shifted towards equity, something like a 60-40%, a balanced model. So 60% was equity driven, 40% was fixed income or bonds. This would be considered somewhat of a balanced portfolio. Now, when we rebalance consistently, we're realigning the weightings of the portfolio based on market fluctuations. And right now in 2022, we've seen a lot of fluctuations. So if we have a run up, or if we have on the opposite side, like we've seen this year, we have a downturn in the market, right? If we do nothing as your portfolio manager, meaning we're a non-active manager for you, you just basically started January 1st with, let's say $100,000 as an example, and you have a 60% equity portfolio. By December 31st, that portfolio, because equities are down this year, is no longer gonna be a 60-40 because everything went down and it didn't go down in equal parts. Rebalancing keeps you at the organized and aligned asset allocation that you set out to do when you first started investing. And it's especially important, why I'm bringing that up here is the number one topic when it comes to your playbook, if you will, speaking of a sports analogy, when it comes to rebalancing, is you wanna make sure you do that, especially in years like this, where you have a lot of the equity portions going down. So rebalancing and trimming off of those ebbs and flows in the market is really important to diversifying your assets and being active on that diversification. This wasn't one of those things where I'm saying, hey, just buy something and hold it. And by the way, I'm not necessarily giving direct advice here on this. This is where you really want to, again, seek your own advisor and find out what makes sense for you. But the topic of diversifying your assets, as I stated at the top of the show, diversifying wins returns, has a couple of, I'll call it subcategories to it, where you want to have some activity to it. Because just saying diversification is probably the most overused term in our industry, but it's really important, And I've used the term actively weighting. You're buying that position that you like, you've researched it, you fundamentally understood the company. That's what we do here at One Capital Management. And we understand the value and their value, the value of the company, whether they're a dividend paying company or a growth company. We want to make sure that we like the company, so we're not just going to trim away from it maybe next week unless something drastically happens that we see in the holding itself, the company, that won't do well in the next year or 2 years or as future earnings show. We also want to manage that portfolio with the risk and how that fits into the remainder of the positions in your portfolio. So it's more of an actively weighting, being active on the portfolio in terms of rebalancing, dividend reinvestments, but ultimately being strategic with each position that we hold for our clients. And like a lot of times the old adage of buy and hold versus daily trading, you want to be there in the middle. Like you want to seek these good holdings, but you don't want to trim off them just because the world's going to hell in a handbasket in your mind. I talked about this a lot last week about what we tell ourselves in our mind, the difference between worry and concern, right? Because worry will usually lead us to inaction, right? It's more of just kind of feeling bad about yourself, saying it's not going to ever come back. It's all doom and gloom. Concern, on the other hand, even though they're somewhat the same adjectives, depending on how you use them, right? Concern is actually a good thing. It leads you to action. It leads you to talk with your advisor about something to make sure that you're on the right path and that what the advisor is doing during a time like this matters. So make sure you're telling yourself, right, that you're concerned, not worried, because if you're worried, then you're really letting that noise in and you want to talk through that with your portfolio. Because as I always say, the 2 Ds, discipline and discernment. And I would also stress this, that a good portfolio should focus on quality, not necessarily quantity. And what I mean by that is really two things. One is the actual positions you hold. You want to find quality in making sure that that word quality, what it means for you, is where an advisor will come to you with help to design a portfolio. But then again, it's also not just on the holdings, but also on the trades. You don't want to be just actively trading to kind of show that you're doing something and being active. You want to be purposeful with the trades you're making. You want to be very poignant and how you're making those trades. You always want to have purpose to the rebalancing, to the alignment of the portfolio, all the assets that are in there actually, and making sure it all works together. So if you want to break it down, the words of diversification and rebalancing, they're somewhat, if you think about it, defensive words in a way, right? Which is why I'm bringing up the notion, again, tying it to defense wins championships and diversification wins returns. It's a simple understanding. It's the practice of spreading around your investments, that your exposure to any one type of assets isn't overexposed, but it's also not underexposed. Something else I want to bring up that I think is a very important thing to discuss, those who hear the word retirement, they're in their 30s and 40s, again, you're like, Brad, that's so far off. I don't want to think about it. A lot of retirement has to do with how you set your investments up now. So don't just shy away because someone said the word retirement and it's some sort of retirement plan, some sort of booklet or something like that. This isn't that. This is making sure we focus on what a retirement plan means to you, whether you're 25 or 30 or getting closer to retirement, because the word retirement really has to do with how you perceive it. When you want to be financially free, to choose to work versus having to work are very different. Essentially, instead of you working for your money, you are now having enough assets saved that your money can work for you. I've said this before, I'll say it again. Money is a great employee, but a terrible boss. Put that ball in your court. So find those star players to work with you. And those could be a financial advisor, it could be a good tax advisor. You are the head coach and team owner of your financial journey. So put together your team to help distribute the ball to move down the field. Because, we need to put financial points on the board to win the game and protecting the assets like a good defense. And again, back to my Pete Carroll analogy of snatching victory from the jaws of defeat, you want to make sure that when you're building your plan, doing all the investments, having a good advisor and a good team around you helps you avoid bad decisions when you have 1 second left, fourth down, and you're on the 1 yard line. We don't want to be the Pete Carroll of your financial journey. And being that it is Wednesday, November 9th, yesterday, November 8th, was election day, as we all know. And I wanted to share some things that I've been talking about with clients that I thought were some interesting stats. I'm going to put up here on the screen here for a second, the US stocks across the election cycle. Now, as you'll see here on the left, it talks about the average fourth quarter US stock performance across election cycles. This goes all the way back, by the way, to 1926. Now, what I want to show here in the fourth quarter, really all years, shows about a 3.8% average return, but during midterm elections, it's almost double at 6.5%. Now, I want to be very clear here. At the bottom of the screen, you can also see that historical performance doesn't reflect future gains by any means, but I wanted to share this in the sense of midterms elections are interesting, and people like to tie in politics and geopolitics with the market. I talk about it a lot, but again, what comes out of DC isn't necessarily how the free market takes things. It's just understanding the sandbox, if you will, that companies have to play into. You'll see also on the right here, putting that screen back up there, that US stock performance in midterm election years are also interesting. This is the average monthly return in midterm election years, again, going back to 1926. And you can see October, November, December have actually fared really well compared to the previous 3 months during midterms. Now, I wanted to share this simply to state this, that again, what we see here in the past of averages over nearly the last 100 years doesn't necessarily mean what we're going to see this fourth quarter, but it also brings up the notion that, elections are interesting times when it comes to markets, and there's actually more positive out of election or midterm elections, I should say, than negative. Just something to take note of. Now, with that, I also wanted to share one other graph that I thought was really important for us today to go through. It's the performance following peaks of inflation. You can see on the left, it's a scatter plot graph here that says peaks in the inflation rate since 1926 and the 12-month change of the inflation rate. Now you'll see there, as of June of 2022, we had a peak of 9.1%. Many of us remember that. I've talked about it a lot over this summer. And on the right, it shows the returns following peak inflation rates. Okay. Something to note here is you'll see there. You see on the left says peak inflation and the years, 1932, 42, 47, 51, and so on and so forth, okay? On the right, you'll see stocks and bonds. Focus on the stocks for a second. You look at the next 12 months. So in our case, just to put this as a case study, for example, this would be a June of 2022 over the next 12 months till June of 2023. That's what the next 12 months means in this graph. You can see some of these performance numbers in the past. Again, to be clear, historical rates of return doesn't mean it's going to be the future, but it shows you the history of some of these quote unquote same kind of environments that we're in of peak inflation, what the next 12 months did. Now, the one outlier in there, as you can see, is July 2008, because that one was a Great Recession and it actually took 18 months. It wasn't a quick blip of a recession. So that next 12 months of peak inflation actually was still heavily down. Now, you also see on the right, though, that bonds were up almost 8%. So you look at the average of the next 12 months returns following peak inflation rates, we have an average of 21.3%. This isn't, by the way, to share it. I've said this before and I'll say it again. We don't get paid to be bullish or bearish. Like, that's not our job. Our job is to be objective. And I'm not trying to tout the S&P 500 returns here. What I am saying, though, is remember to look longer term than just today. Because a year like this for investors, and I have talked with a lot of clients on this, we get really myopic and it becomes really long days, especially like last week when you saw the market erupt because of Jerome Powell's, the federal rate increase again and the fluctuation there. We're gonna have these kind of movements in a year like this. Don't lose sight of your longer vision. Stay disciplined and stay discerned about what you're investing in and who you're investing with. Now, before we go, if you found anything helpful today and want to learn more, you can visit us on our website at onecapital.com. You can also call or text us. We want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, we value our relationships. It's the lifeblood of what we do. So click, call, or text us today. If you're not following us on social media, you should be. You can follow us at Make Your Money Matter. We're sharing great information on all of our social media platforms. And as I often say, if you like the show, share it with someone you like. I guess if you don't like the show, share it with someone you don't like. But until next time, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.